All right. Good afternoon, everybody. Welcome once again to the weekly live webinar presented by Affinity Federal Credit Union. Today's topic is Investing 101. We'll be learning about different what are investments, what kind of investments are out there, and things to consider once you are ready to start investing, or if you already have a portfolio put together, things to consider about how to better strategize. My name is Oscar Cordova, and I'm the External Affairs Specialist here at Affinity. I'm in charge of the financial education efforts of the credit union focused in the areas that we serve. Our presenter today is Tony Dologowski. He's the program manager for our Affinity Investment Services. He's been with Affinity for the last 3 years and has been in the investment field for over 20. So I encourage everybody to ask questions. He's our expert today, so he'll be able to answer the questions that we need answered.
Okay, well, thank you, Oscar, and hello, everybody. Like Oscar said, we're going to talk a little bit about investing today, but first, here are some disclosures. It should be noted there are no perfect investments. So with every investment, there are benefits and drawbacks. There are also fees involved. So as I talk about certain investments today, I'm by no means implying there's a particular investment that is right for everyone. As other seminars, you may hear pitch for a specific product or investment, but you're not going to hear that today. We believe there is no perfect investment. This workshop is for informational purposes only, and the factors we will be discussing are just some of the things we take into consideration when helping our clients. So here's what we're going to cover today. So we're going to cover a few topics, all of which are designed to give you a brief introduction to the world of investing. So what's the big deal about investing? Do you know that you should invest but don't know where to start? If so, then this is the right place for you. In our talk today, we're going to learn about investing from the ground up, covering investing basics and some of the most common types of investments. So what is investing? Essentially, investing means putting your money to work for you. Growing up, most of us were taught that you can only earn an income by getting a job and working for a wage. And that's what most of us do. However, the problem with this scenario is that in order to make more money, we'd have to work more hours and then only so many hours in a day. Since we can't create a duplicate of ourselves, what we can do is put our money to work for us instead by investing. This maximizes our earning potential, whether or not we work more hours, earn a raise, or look for a higher paying job. There are many ways to invest in many types of investments, such as stocks, bonds, CDs, mutual funds, and many more options, some of which we will discuss later in the presentation. This brings us to what investment isn't. Investing is absolutely not gambling or get-rich-quick schemes. Some people may treat investing like gambling by betting on the ups and downs of the market or investing based on hot tips. We don't encourage that kind of investing because we don't think it works very well. Long-term investing requires careful thought, analysis, and discipline. A good investor doesn't act on hunches or emotions, but instead weighs the pros and cons of every decision. So it's important to understand there are no guarantees in investing and risk is always with us. However, there are ways to mitigate certain kinds of risk and strategies we can use to help put the odds in our favor. So why invest? Long-term investing offers some of the best opportunities to grow wealth, fight inflation, increase personal freedom, and ensure a comfortable future for ourselves and our families. Investing is also becoming something of a necessity for most Americans. The days when everyone worked for the same job for 30 years and retired with a nice pension are gone. We're not even sure how much longer Social Security will be with us. For average people, investing may be one of the best ways to retire comfortably and maintain a comfortable lifestyle. Having said that, it's important to remember that investing involves risk, and positive results can never be guaranteed. So who should invest? Pretty much everyone. It may sound silly, but almost anyone can benefit from long-term investing. Children can learn to manage money and invest for college. Young adults can open retirement accounts with their first paychecks and start planning for major life goals, like a first home. Adults should begin planning for retirement as early as possible, and after retirement should shift their investing strategies towards ensuring their money lasts them all through retirement. It's important to note that every investor is different and no single investment strategy works for everybody. So now we're going to talk about personal risk profile. Risk in this context is the degree of variability in investment returns or potential for investment loss you are willing to accept. Determining your own comfort level with risk is critical to sticking with a long-term investment strategy. Investors who take on too much risk may panic and sell at the wrong time or expose themselves to losses they can't afford to make. Putting your goals and your personality together can help you figure out your personal tolerance for risk and how you will react to market movement. We've included other factors that will affect your risk tolerance are time horizon, your future earning capacity, and the presence of other assets like pensions, Social Security benefits, or an inheritance. So next we're going to go over some basic investment types. Certificates of deposit. A certificate of deposit is a promissory note issued by a bank and insured by the FDIC or NCUA that pays a holder a stated interest rate. CDs can be issued in any denomination and generally have terms ranging from 1 month to 5 years. Unlike a bond, CDs are typically not sold on the secondary market, but are held until maturity. It is possible to withdraw funds from a CD early, but this is going to incur penalties sometimes. Next, we'll talk about bonds. Bonds are another very common investment. Essentially, a bond is a loan you make to a government, corporation, or other entity. Bonds are part of a category called fixed income investments. This is because in exchange for loaning them the money, the bond issuer agrees to pay you interest on your money and eventually pay back the amount of money you lent out. The interest rate is stated up front and it's determined by prevailing interest rates and the risk associated with purchasing the bond. Ratings agencies use rating designations to indicate the credit quality of the bond and the issuer. Generally, bonds in the A or high B category are considered to have low risk of default, while junk bonds in the C category are considered to have significant risk of default. Default is the risk that the issuer won't pay back your investment principal. Bonds are popular among investors who are looking for income. One of the main attractions of investment-grade bonds is their relative safety from loss of principal. For example, bonds issued by the U.S. Treasury are considered to be risk-free since there's virtually no chance that the government will fail to pay back your initial investment. However, that safety and stability comes at a cost. Because there is little risk involved, there's little potential return on highly rated bonds. Mutual funds. Mutual funds are one of the most popular investment options today. A mutual fund is a collection of stocks, bonds, or other investment types. When you buy shares of a mutual fund, you're pooling your money with a number of other investors. This enables you, as part of that group, to pay a professional manager to select investments and manage the fund. Mutual funds are set up with specific investment strategy in mind, which is spelled out in the prospectus. They can focus on nearly any kind of investment, large stocks, small stocks, government bonds, or corporate bonds, a mix of stocks from certain countries, etc. One of the major advantages of a mutual fund is that you can take advantage of this professional management. Typically, managers are paid according to the performance of the fund, meaning they have a vested interest in delivering results. However, professional management comes at a price, and most mutual funds charge an annual management fee. Another advantage is that mutual funds offer a simple way to diversify your portfolio, since even a small amount of money can be shared across many investments. An ETF, or exchange traded fund, looks like a mutual fund but trades on a stock exchange like a stock. ETFs are designed to replicate the performance of an underlying index like the S&P 500, while a mutual fund can hold any security that is in line with which is in line with its investment strategy. ETFs only hold investments listed in the underlying index. For this reason, unlike mutual fund, ETFs are considered to be passively managed. Benefits of ETFs, they typically have lower management fees than mutual funds, and they can easily be traded on exchanges. However, you may incur trading expenses if actively buying and selling those ETFs. Stocks. So when you purchase stocks, which are sometimes called equities, you become part owner of a company. This ownership gives you the right to vote at shareholder meetings and sometimes allows you to receive a share of the profits of the company through dividends. Not all companies offer dividends, and they aren't guaranteed, but when offered, they can be a good source of income. High-quality stocks are simple to buy and sell in the open market, meaning you can easily sell your stock when you want. Stocks can be an excellent way to increase wealth and fight inflation due to their ability to increase value over the long term. Historically, stocks have offered the highest returns of any other asset class. However, these results are not guaranteed, and past performance can ensure future returns. One of the major drawbacks to stocks is that they can lose their entire value should the underlying company go bankrupt or suffer unanticipated losses. Stocks can also be highly volatile, meaning the value of your investment can go up and down significantly. Next, we'll talk about some alternative investments. So now that you learned a little of the basic investment types that most investors will hold, we'll talk about these alternative investments, which is the name given to investments that fall outside of the basic investments like stocks, bonds, mutual funds, annuities, etc. Categories contain hundreds or thousands of complex securities that we're not going to be able to cover today, but we'll at least discuss a couple of the more common types. Precious metals, particularly gold, are often used to hedge against economic downturns, since gold prices often move counter to the economic trends. Gold is highly volatile and should be considered a speculative investment. Next is annuities. Annuities are a popular tax-deferred investment option for investors at or near retirement. An annuity is a contract between you and the insurance company that gives you the right to annual income for a specified period of time. During the initial stage, you make contributions to the annuity, which are allowed to grow on a tax-deferred basis. The word annuity literally means annual payments. The annuities we will be discussing are typically investments meant for long-term, for your retirement. As such, they may have surrender charges if money is withdrawn early and could be subject to a 10% tax penalty if money is taken out of them prior to 59.5. Also, annuities themselves have fees and expenses associated with them. Annuities may have separate account management fees and other insurance costs such as mortality and expense fees. So there are two major types of annuities, deferred and immediate. With an immediate annuity, you pay the insurance company a lump sum and begin income payments right away. You can choose whether you want income guaranteed for a specific number of years or over your lifetime. The insurance calculates your income payments based on the original investment and your life expectancy or payment term. And as you can see, any guarantees offered by an annuity are subject to the claims paying ability of the issuing insurance company. A deferred annuity has two phases: the accumulation phase, during which you contribute and let your money grow, and the payoff phase, during which you begin to receive scheduled payments. During accumulation, earnings grow tax deferred until withdrawn. During the payoff phase, which typically starts during retirement, you can choose how much to withdraw each year, usually up to a maximum of 5 or 6%. So this means you can control when you take the income payments and when you pay the taxes on them. Investors also have the option of choosing between fixed and variable annuities, strategies, which differ in the way they generate earnings and the amount of risk involved. So next, we're going to go over some basic investment principles. First is risk versus return. A basic tenet of investing is that you cannot achieve returns without taking risk. Balancing risk and investment returns is one of the fundamental challenges of investing. Anytime you invest money into something, there's a risk that you might not get it back. Investment returns should compensate you for the risk that you bear. So in theory, the higher the risk, the higher potential return, and the lower the risk, the lower your expected returns. One of the ways we manage risk is by creating a foundation of investments like cash, highly rated bonds, mixed with more volatile investments like stocks and stock mutual funds. To try to generate higher returns, we may even add a small amount of riskier investments. Since no one can predict or control market movements, the idea behind the investment pyramid is that we want to generate returns while attempting to control risk. So next is time horizon. This is another very important factor in developing an investment strategy, and it can basically be defined as the amount of time you have until you need to withdraw your investment. Time horizon can range from seconds for a day trader all the way up to decades for a buy and hold investor. There's no right time frame for everyone. It just entirely depends on your personal goals. It makes sense that a person who is investing for retirement, day 25 years away, would choose different investment options than someone who was saving for a down payment in 1 year. Time horizon is closely related to risk because the shorter your time horizon, the less time you have to recover from short-term investment losses. So this means, generally speaking, the shorter your time frame, the more conservatively you invest. This chart up here demonstrates this relationship, showing that the longer the investor's time horizon, the more risk he or she may be able to take on to see greater potential returns. It's important to note that time horizon is only one factor that we consider when picking investments. Next, we'll talk about asset allocation and diversification. These are powerful tools we use to seek returns while attempting to reduce your investment risk. Asset allocation allows investors to spread the assets across multiple types of investments like stocks, bonds, cash, etc. Your asset allocation will change over time due to your shift in investment goals, time horizon, and other factors. Diversifying a portfolio means reducing exposure to any single category, industry, country, or investment in order to limit that risk. The idea behind diversification is that a portfolio of different kinds of investments perform differently at any point in time, meaning that the decline affecting one investment may not affect your entire portfolio. So that said, it's important to note that diversification may not protect your portfolio from loss when the markets as a whole decline. Accumulation versus distribution. Generally speaking, there are two basic phases in a lifetime of investing: accumulation and distribution. During the accumulation phase, investors are working and hopefully contributing an increasing amount of their savings and investments each year as they approach their peak earning years. The goal during this phase is to build up a portfolio that, when combined with Social Security, pensions, and other income sources, will give the investor a comfortable retirement lifestyle. During this phase, the impact of investment losses is smaller at the beginning since there's less money invested and more time to make up for those losses. The impact of losses increases as the investor approaches retirement, which is why we generally counsel more conservative investing strategies as our clients near their retirement dates. As we're painfully aware, investments don't always grow, which is why it's critical to match your investment strategy to your personal risk tolerance during the accumulation phase. So due to the power of compound growth, regular contributions during the accumulation phase have more leverage than regular distributions have during the distribution phase. This is why it's so important to make consistent, increasing contributions to your retirement assets. The second phase of investing is the distribution phase, when the investor is taking money out of his or her portfolio to cover living expenses. While the portfolio will still be generating investment returns, gains will be reduced by regular withdrawals. The goal in this phase is to make sure that your nest egg lasts as long as you need it to. So we talked about the two main investment phases, but there's actually 4 phases of an investor's life. The wealth accumulation phase, when you're working and hopefully contributing those savings. Like we said, due to the power of compound growth, accumulation phase has more leverage than regular distributions have during the distribution phase. This is why, like we said, it's so important to make those consistent contributions to your retirement assets. Then follows the wealth preservation stage, which is designed to protect what you have built in the first phase. The portfolio's ultimate size at retirement will depend on the size of the investments, the returns on those investments, and the length of time before withdrawals begin. So as we talked about, then there's the phase of distribution, when the investor is taking money out of his or her portfolio to cover living expenses. While the portfolio will still be generating investment returns, gains will be reduced by regular withdrawals. The goal in this phase, like we said, is to make sure your money lasts as long as you need it to. The final phase of an investor's life involves transferring wealth to children and loved ones. While it's a little bit beyond the scope of our discussion, estate planning is a very important and something most investors should start planning for fairly early on. So here's something very important. Avoid emotional investing. Successful long-term investing requires discipline and the ability to avoid giving into emotion. One of the major mistakes many investors make is to give into the emotional investing roller coaster. So here we have an illustration of how it can feel to watch your investments gain or lose value. Oftentimes, when we see our life savings losing value, our instincts and emotions drive us to make bad decisions. Being aware of and in control of your emotional state is critical to make clearly reasoned investment decisions. One of the benefits of working with a financial professional is that we can provide a voice of reassurance and rationality when emotion sets in. Pay yourself first. One of the most important factors in long-term investing is maintaining consistency and investment discipline over time. There's no way to predict with any certainty which way markets will move. Some investors attempt to time the market, try to invest during the dips, and lower their cost per share. Unfortunately, investors have been shown to be terrible predictors of market movements. A more systematic approach is to invest the same amount regularly over a period of time. This is what's called dollar cost averaging, and it may help market fluctuations have less of an effect on your actual cost per share. While dollar cost averaging cannot guarantee profits or protect you from losses, it does help you avoid the guesswork and stress involved with timing the market. Dollar cost averaging is investing the same amount regularly over a period of time, such as monthly, so that market fluctuations may have less of an impact. And like I said, it doesn't guarantee against losses, and it's not for everyone. So in order to successfully lower your per cost share over time, you have to have the discipline and financial resources to be able to consistently invest. It's important to work with a financial professional to determine whether it's an appropriate strategy for your needs and goals. Savings versus investments. While we sometimes use savings and investments interchangeably, it's important to note there are some differences. Savings are for emergencies and form the foundation of a financial plan. Your savings should be kept highly liquid in highly liquid accounts, such as saving accounts, money market, mutual fund accounts, or short-term CDs, so that you can access them quickly without having to sell out of your investments to cover emergency expenses. Investments are for long-term financial goals like buying a home, paying college or retirement. This is simply because most securities are poorly suited for short-term and may lose value. Okay, here's another very important thing, spotting scams. Now, it's an unfortunate reality that investing scams exist, but these common sense rules can help you protect yourself and your assets from unscrupulous scammers. Some investing scams often use high pressure sales techniques. They may promise very high returns and guarantee you against loss, which nobody can do. Claims to use proven or secret investment formula that no one else knows. So those are some pretty common scams that we see. And we'll just go over the conclusions and some next steps. tying it all together. So I've introduced a lot of new information in this presentation. I hope it hasn't been too overwhelming. Please remember that what we've discussed today is just the tip of the investing iceberg. Nothing we said is meant to give you personal advice, and there is no one-size-fits-all approach. As advisors, we take our responsibility to educate and inform seriously, and our goal with this presentation is to set you on the right path of investing. There are many investment strategies out there. For most investors, the smart route includes saving regularly, starting as early as possible, sticking to a solid financial plan, and avoiding investment pitfalls. As advisors, we also believe in the value of professional advice. And are there any questions out there?
All right, so thank you so much, Tony, for this great presentation. And I hope it was very informative for all of you. At this point, I would like to open up the floor for anyone who has a question. You guys can ask the question in your question and Q&A option on your panel. Also, I want to remind everybody that this presentation is being recorded. And so I will be sending this evening a follow-up email thanking you for attending, along with the link to rewatch this presentation, and also some other great resources that we like to share with all of our membership in regards of investments and getting more information about those. So with that said, I would like to open up the floor for any questions. I do see that there's one question here. Hello, will this be recorded? Yes. Thank you so much for asking the question. The information, the question is, the webinar is being recorded. So I'll be more than happy to make the link available for all of you to rewatch the presentation. Thank you. Next question, Coinbase, not banking product. However, what are your thoughts, Tony, about Coinbase?
Yeah, that's not something we really deal with here. You know, it's pretty volatile and it's not something we do a lot of. There is money to be made, but it's really not something I'm qualified to, you know, to comment on. I would definitely do research if I were you, and I would definitely, you know, go into it knowing that there's a lot of volatility in there. So.
Thank you so much.
Sorry, I didn't get a better answer. That's a tough one.
Yep. Thank you so much for the question. I have another question here this afternoon. How do advisors make money by helping us build a portfolio?
There's a few different ways they can make money. It depends on what you want to do. They may get a commission off of what you buy. There may be, if you're looking for them to manage the portfolio for you, there may be management fees involved with that. There also are options where some people just want to have advice, but they don't want it to be managed by somebody. So maybe they might charge for the plan, just to put a plan together. And these are all things that when you meet with an advisor, they will lay out for you. They will tell you, hey, this is the type of investment, this is how you get paid, and you can always ask them, hey, how do you make money off of this particular plan that you're putting together for me?
Great. Thank you so much for that question. There's another one this afternoon. I would like to know about 529 plan investments. Is there a certain amount you must have to start?
I apologize, I don't have the exact amount, but I know 529s have a very low starting threshold. They're not, some mutual funds will, you may have to put in 250,000, 2,000 up, but 529s are not usually like that. Because there's 50 different ones, so I can't give you a great answer on that, but I know they do have very low starting points for 529s, and they are built specifically for that reason, is because they want people getting in there investing as much as soon as possible. I believe, and if you want, you can get my contact information. I can follow up with you on this, but I believe it's as low as $50 for something.
Yes, thank you so much for the question. And Thank you so much, Tony, for reminding me. As part of the follow-up email, I will be including information as well in case any of you have a question or to speak with a financial advisor. Either I or Tony can put you in touch with one, which leads us to our next question. And the question reads, does Affinity have investment advisors?
Yes, we do. We do have advisors. We have 7 advisors. They are fully licensed. And they are there to help you with, any questions you have and anything they could, anything that comes up.
Thank you, Tony. Next question. Do you guys work with investing 401ks?
See, there's a couple different ways we can help. We do help with companies investing 401ks. We can work with you if you, as part of an overall portfolio, if you want them to, kind of look at your 401k and see if it fits and how that can fit into other investing. We generally don't give advice specifically on somebody's 401k because it's not something we have any control over. Usually what we'll do is just have you go to your provider for any type of advice that you need. But yeah, depending on your situation, we can help depending on what you're looking to do. It goes like I said, depends on what you're looking. When you say advice, how much advice you need.
Perfect, very good. Next question. What type of investing and how much money to use do you recommend for beginner investors?
Again, that's entirely up to you. I would invest what you're comfortable with. Because sometimes if people invest too much and there's market fluctuations, they tend to make those emotional decisions like we talked about before. Figure out how much you're comfortable doing. I would do, what I do is every week I put, every 2 weeks we get paid and I put money into my investments. It's kind of like that dollar cost averaging. So you have to figure out what you're comfortable putting away, and then you can go from there. And to get back to the 529, I just looked it up real quick. Franklin Templeton, if you go through NJ Best with the 529, it starts as low as $25. So like I said, they have a very low threshold to get into those.
And
The lowest.
I'm sorry. And I guess it also has to do with your personal profile, right? Which is what you do.
Yes.
On the presentation, when you will have a deep conversation with a financial advisor, and then they'll be able to figure it out. What are your goals? How much money you have? What is the strategy? How to get to achieve those goals, right? So we different goals.
One of the good things about it, I'm sorry, Oscar. But one of the good things about investing and dealing with an advisor is if your situation changes, you can change the amount that you're investing. You're not locked into anything. So that's one of the benefits of working with somebody is, you can sit down with them, determine, hey, listen, this is how much I can invest. Excuse me. This is how much I have available. This is how much I can afford to put away. But if your situation changes, you can increase, you can decrease, however you want. That's what they're there for. They're there to work with you in your situation.
Excellent, very good. Now, next question. What is the lowest amount we can invest with Affinity?
Again, that's kind of a tough question because it depends on what you're looking to do. As far as mutual funds, if you're doing just a mutual fund, usually you need at least a few $100s. If you're going to do any type of managed money, you need at least $5,000 for what's called our GWP. If you want to go to our next level, it's 25. But don't be shy about asking. If you don't think you don't have enough, because if nothing else, we can at least guide you in the right direction. If you say you only have a couple $100s, we might be able to at least say, hey, listen, this is something you want to try.
Excellent, very good. So I don't see any other questions this afternoon. So at this point, I'd like to bring this presentation to a close. I would like to thank everybody for attending this afternoon and being part of this webinar. I think the topic was great. I think the engagement at the end with the questions were also great. If you guys have any questions that you guys missed today or want to ask on a more one-on-one scenario, you can always shoot me an email and I'll connect you with Tony or one of our financial advisors, or you can reach Tony directly. And I'll include his information for you to do so. Okay. So at this point, Tony, do you have any parting words?
No, just like Oscar said, if there's anything else that comes up, just feel free to reach out to us. You can go on our website and find an advisor for the branch that you're associated with. Just, feel free to reach out to us. Okay.
Excellent. Thank you so much, Tony, for being a part of our presentation this afternoon. And thank you everybody for attending. You guys have a great afternoon. I'll see you guys next week in our next installment of the Affinity weekly webinar. Thank you so much. You guys have a great afternoon.
Hey, thank you, Oscar.
Bye-bye.